Johnson & Johnson is preparing to spin off its consumer unit in what could be the biggest IPO this year. J&J is looking to raise more than $3.5 billion in the public markets at an almost $40 billion valuation. The new company will be called Kenvue and will offer well-known brands such as Tylenol, Band-Aids, and Johnson's baby powder. Those products accounted for 16% of J&J's sales last year. The Kenvue Roadshow kicked off last week. So, Scott, we've talked about spin-offs before. As you've explained, the thinking behind a spin is that the assets being spun would get a higher multiple as a standalone company versus being bundled together and priced with the rest of the larger corporation. But I want to talk about what it means to go on a roadshow. There's no official listing date yet, but Kenvue has set a target price. They found their underwriters in Goldman Sachs and JP Morgan. Take us through what things look like from here until the official IPO.
So I've only been involved in one roadshow, and that was when a company I founded called Red Envelope went public. But I've sat in a lot of presentations. A roadshow is essentially the bankers and senior management put together a deck and a presentation and go meet with institutional investors, try and drum up interest such that the night before the IPO, when it's pricing, they come out with a price, and then the institutional investors call and say, we want 10 million shares. And ideally, you want the offering to be oversubscribed such that there's a small bump and everybody makes money. Now, you don't want it to double, right? When Airbnb went public, it priced at 68. It came out, I think, at $150, which meant that the bankers, Goldman and Morgan Stanley, left a lot of money on the table. And that is Airbnb sold 10 or 20% of its shares for 0.5x of what they could have captured had it been priced to where the market was. You want a little bit of a bump, but not too much of a bump. Even worse is if the stock's first trade, where it's priced at $20 and it closes the first day at 15 or 18. I think Coinbase was a broken IPO. It's called a broken IPO. It creates a stench around the company that, the market and the company, or the company and its investors, fooled some initial institutions into buying this thing, and it went down, and it creates sort of a stench around it. So it's not only a fundraising event, it's a branding event, but the roadshow is essentially their storytelling, where they go around the nation. I've actually helped a lot of CEOs on this initial kind of pitch, if you will, on the roadshow. And they're basically trying to say, this is the background of the company. This is the basic concept. This is the total addressable market. These are our barriers of entry. This is why we're so unique. Here are the numbers. Look at how this all adds up to an incredible business. It's high margin, high growth. And they want to get everyone's greed glands going, create the illusion of scarcity where we're not selling that many shares, and hopefully get a really robust book such that they can strong arm the bankers into setting a high offering price. And there's always a kind of a bit of an arm wrestling over the company wants a higher offering price. The bankers want a lower offering price to ensure they sell out and they make some money. Because they're
why does that? Yeah, could you take us through why the bankers would want a lower price? Why does it matter that the shares sell out when they go public?
Well, there's a couple things. One, for a brief moment, I believe the investment banks actually are underwriting or holding on to the stock, so they can get caught in a bad place if the stock goes way down. They have something called a green shoe, where they actually have the right to sell more shares and make fees on it. If the stock goes up, everyone's happy. They then get a lot of follow-on business in terms of wealth management or asset management. They get about between 4 and 7% of the proceeds, or a discount of 4 to 7% on the stock when they take it public. So there's just fees everywhere and money everywhere if the stock goes up. And so they want to price it below market. But keep in mind, that's what the existing shareholders, the management team, and the private investors, or the folks who invested when it was a private company, that's what they're selling the stock for. They're giving up the stock at the price, at whatever the investment bank price is at. It's the people who buy the stock who recognize the upside, and also the existing shareholders. So it's a bit of a dance. The only learning here is that if I were to, someone asked me at a conference, what skill would you want your kids to have? Do you want them to take Mandarin or computer science? And I said, neither of those. If I wanted to impart one skill on my sons that I think is enduring, it's storytelling. And when the CEO stands up in front of, when Jeff Bezos went on his roadshow, I can tell you that within about 3 minutes, every person in the room wanted to buy stock in Amazon, regardless of what the price was. Because you just listen to this guy, and he has such a vision, and he's so kind of calm. You just think, this guy's going to make me a lot of money. This guy's going to build an unbelievable company. So the roadshow, the roadshow is really the storytelling to institutional investors. And in this instance, what might be interesting about this IPO is whether or not it will kind of summon the dead from what has been a literally winter, a long winter in the IPO market. The IPO market is effectively shut. This is more of a defensive stock. It's more enduring. It's not tech. People are going to want to own this name. Now, why are they doing it is also sort of interesting. And that is when you have a conglomerate, which is what J&J is right now, and that is they have different types of businesses all wrapped into one stock. And I believe J&J is one of the most valuable companies in the world. Mm-hmm. The market doesn't like it. It doesn't want to take the time to try and evaluate every business and create a valuation and do a bottoms-up valuation. What it usually does when it gets confused, when different businesses are jammed together, it finds the shittiest business, the lowest growth business, and it assigns that multiple to the entire business. So the disarticulation of assets and businesses that creates a cleaner story across those businesses creates a whole that's greater than the sum of its parts. So this could be one of two things. This new spun unit, Kenvue, might be higher growth, might be in a sector that the markets are more excited about, and as a pure play of the consumer unit might trade at a higher multiple, or the core business, the non-consumer business of J&J, might be getting weighed down by the consumer unit that's not growing as fast. This is what people call the good bank, bad bank. And that is separate assets so there's a cleaner story. And when there's cleaner stories, the good assets will trade at a higher multiple. The bad assets will trade at a lower multiple, but when you mix the two, it all trades at a bad multiple. So the disarticulation of assets, a cleaner story, is accretive to shareholders. So I would imagine this IPO will be successful. And I think the market is really pulling for it because people would like to see a thawing in the IPO markets.
Yep.